This dashboard tracks the crypto market fear and greed index. Right now, it is locked at 8 out of 100. Bitcoin sits at $67,485, and Ethereum is hovering at $2,057. For the average retail investor, seeing metrics drop to this level triggers immediate dread. It signals a complete market capitulation. But for protocols built with a specific architecture, capitulation-level sentiment is not a threat. It is a strict mathematical advantage. Surviving a severe market downturn requires removing human emotion from the equation entirely, relying instead on objective, verifiable mathematics. To understand why, we first have to look at the mechanical failure point of most decentralized finance projects. When extreme fear hits, it triggers a cascade known as the DeFi death spiral. A typical protocol operates by requiring a constant influx of new user deposits to remain functional. This diagram illustrates what happens when the market panics. Trading volume drops by 60 to 70. New deposits completely halt. Without that fresh capital, the yield collapses towards zero. Finally, because the protocol's treasury is usually denominated in its own native token, the treasury loses its financial backing as the token price falls and the capital completely depletes. The Day182 long-term report for the PLAZM protocol reveals a stark deviation from this model. Look at these metrics. Despite the broader market panic, PLAZM has permanently burned 19% of its supply, and the protocol is currently generating $436 a day in yield. It is achieving these numbers with a micro-market cap of only $185,940. These figures are the direct result of a distinct structural architecture that insulates the protocol from external panic. The primary mechanism protecting the system is structural decoupling. In this architecture, the yield distributed to the protocol does not come from new PLAZM depositors. Yield is sourced entirely from trading fees on a separate decentralized exchange called DexFi. Traders pay fees regardless of market sentiment, and those fees flow directly to PLAZM bondholders. The vault holds 208.65 ETH, valued at $429,258, generating 37.06% bond APR. Today, in the absolute depths of extreme market fear, those bonds generated exactly $436.25. The protocol did not need a single new user to function, and exactly 0 new PLAZM tokens were emitted today. By physically decoupling yield generation from the price of the native token, the system becomes mathematically immune to capital starvation caused by market sentiment. Yield generation is only one side of the equation. The other is supply reduction, executed through the protocol's buy-and-burn engine. The system operates on a fixed budget, spending roughly $284 per day to purchase and permanently destroy tokens. Because the daily spend is fixed, an inverse mathematical relationship emerges. The lower the token price drops, the higher the volume of tokens destroyed. Comparing burn rates, 3 months ago at 2.5 cents, every dollar spent destroyed approximately 40 tokens. Today, extreme fear depressed the price to roughly 1.7 cents. At this lower valuation, that exact same dollar now destroys 57.5 tokens. The market crash directly resulted in a 44% increase in burn efficiency. This heightened efficiency means the protocol is now permanently removing approximately 16,321 tokens from circulation every single day. For a fixed budget burn system, a severe drop in token price acts as a massive operational accelerator, rapidly compressing the available supply. Extreme fear provides a second mathematical advantage through a mechanism called buy and grow. Just like tokens, the prices of the perpetual yield bonds that power the protocol drop significantly during market panics. This dual-axis chart maps bond prices against acquisition rates. As the cost of bonds declines, the fixed daily budget acquires vastly more yield capacity per dollar. Right now, the system is adding 2.5 new bonds to the vault every single day. By continuously reinvesting at these discounted rates, the vault has grown from 11,000 bonds at Genesis to 12,323 today. That is a 12% increase in total holdings, generated entirely from compounding lower-priced assets during the downturn. The panic provides cheaper fuel, allowing the protocol's vault to accumulate assets much faster than it ever could in an optimistic bull market. When we zoom out to look at the macro impact of these supercharged burn mechanics, we hit a major milestone. This bar represents the total token supply of 10.68 million. Out of that total, 2.43 million tokens, exactly 19%, have already been permanently destroyed. Reaching this reduction required a total lifetime spend of $71,890 in USDC by the buy and burn contract. If the current extreme fear destruction rate holds, the protocol will eliminate roughly 5.95 million tokens over the course of a single year. To put that in perspective, the total emissions over the last 7 days amounted to just 96 PLAZM, or about $1.67. Inflation is effectively non-existent. The longer the token price remains suppressed by market fear, the more aggressively the total supply is compressed. Eventually, the broader market will recover, and the fear and greed index will climb from 8 back toward a neutral 50. When that happens, the protocol will enter the bull run with a fraction of its original token supply and a continuously compounding vault full of high-yield assets. Because of these embedded mechanics, the protocol's 80-day radar currently indicates clear skies ahead. An extreme fear rating of 8 is a temporary human emotion. The $436 daily yield is a verifiable on-chain fact. Ultimately, fear is temporary. Mathematics are permanent.